Hello everyone, welcome to Akira's Academy of Accounting and Finance, and today is the day of revision of the dissolution of a partnership firm. That is the last chapter of your part first, right? Now when we earlier talked about there's a reconstitution of a partnership firm, like when there is an addition or some partner die, or if that partner retires, or if there is any change in the profit sharing ratio, then the firms remain the same. There is no change in the firm, but we need to reconstitute it. We need to make certain changes. Likewise, we discussed that if any family member adds into the family, or if any family member leaves the family, there will be certain changes. The house will remain the same. There won't be any certain changes, but there will be refurbishing of certain things. There will be other things wherein certain changes will be there. But what if all the people of that particular house leaves that particular house, right? Then that particular house is not required. You need to sell off that particular house, everything that is there in that particular house. Similarly, when all the partner decides to leave that particular firm, they decide to just close that particular partnership firm, that means there comes the situation of dissolution of a partnership firm. Now, why dissolution? Maybe by agreement they agreed, okay, for this particular period of time we will continue this particular firm and then we will leave. So maybe by agreement. By compulsory dissolution, if they enters into any illegal or unlawful practices, or else there is all the partners have become insolvent, then there is a case of a compulsory dissolution. Even though if there is only one partner who is solvent but all the partners are insolvent, that means one partner cannot be, he can't be a part of a partnership firm. For partnership firm you need more than two partners, two or more than two. Okay, maybe by the happening of certain events or contingencies, like the death of a partner, adjudication of a partner as an insolvent, maybe by notice that the particular partner has given a notice that he don't want to continue this particular firm, he don't want this firm to continue, or else by court. Okay, partner has filed a suit that because of certain reasons there is a loss, or some partner has become insane. So maybe because of all these reasons he has passed a suit in the court, and the court has legally decided to discontinue that particular firm. So these may be the situations when the partnership firm is getting dissolved. Now when the partnership firm is getting dissolved, that means there are assets and liabilities in the books. They need to sell off that assets and they need to pay off those liabilities. So this thing, like when the first and foremost thing that they have to keep in the mind while settling the accounts is whatever is the third party liabilities. Remember, they need to pay those third party liabilities first. Okay, after that, if any partner has any given any certain amount of a loan and the firm has a liability to that partner related to that particular loan, then that partner's loan will be paid off, and after paying off the third party liabilities, payment to that particular partner's loan amount, then the remaining partners will be paid off whatever is left. If nothing is left, fine. If there is any kind of a deficiency, like they need money in the firm, then these partners need to bring that particular amount into the business. Okay, but what they need to bring from? They need to bring it from their personal assets. Now what is a personal asset? The asset that belongs to them only. If it belongs to their spouse or to their children, then those assets are not considered as personal assets. So when the partner has to bring that personal assets into the firm to pay off the liabilities, first he needs to pay off his personal liabilities, and then whatever is left, that particular assets these partners needs to bring to pay off the liabilities. And next thing, if the firm's liabilities are there, firm's assets are there, firm's assets will be used to pay off firm's liability first, and then the firm assets will be distributed among the partners. Okay, now this is all the theoretical. You got to know why and how to do it, right? Now how to close the books. Okay, now there is all the assets and liabilities. Now all the assets and all the liabilities, we need to open those assets and liabilities account. We just need to take into consideration that there will be only three accounts, only three. The first one would be the realization account. Okay, realization account. Realization account will include what? All the assets, all the liabilities, any expenses or income during the dissolution process. Any expenses are incurred or any income they have gained during that particular period, there's no need to open any profit or loss account or any asset or liability account. All these things will get transferred to the realization account. So assets have debit balance, they need to be transferred to the realization account. So what will be the entry? Realization account debit to the assets account. All the assets account will get closed. Secondly, all the liabilities will get third party liabilities minded, right? All the third party liabilities will get transferred to the realization account. So third party liabilities like creditors, bank loan to any other person, loan from any other person, bills payable, even provision for bad and doubtful debts, investment fluctuation fund, provision for depreciation, these things they have kept, these provision they have kept for those particular assets. Okay, if there is any downfall in the assets, those provisions would be utilized. So these provision will not get transferred to the partners, right? So these provisions will get transferred where? On the credit side of realization account. So all these credit balances will get debited, all the liabilities will get debited, and it will get transferred on the credit side of the realization account. Now assets have been transferred, liabilities have been transferred. What remains in the balance sheet? There remains two things. First is partners capital amount. So we need to open a partners capital account, and another thing is bank account, because when we sell off the assets, okay, whatever money we get, we need to transfer it to the bank account. If any liability we are paying, then liabilities will be paid off using certain cash amount. So bank account we need to keep it open. Okay, and partners capital account, so whatever capital amount is there, we need to keep it like that. The reserves and surplus will get transferred to partners capital account. So the general reserve, workmen compensation fund, any kind of reserves and surpluses are there, they will get transferred to partners capital account. And one asset, that is fictitious assets, will also get transferred to partners capital account. Now you will be like, what are fictitious assets? Fictitious assets are this, that they have incurred the expenses and been incurred, but they believe that the benefit of these expenses they will get for the future 2 to 3 years. Likewise, we discussed about the advertisement expenditure. Now advertisement expenditure, it's a heavy expenditure, they have incurred those advertisement expenditure, and that advertisement expenditure they have not charged fully in one particular year, because they think that those advertisement expenditure benefit they will get in the future year. So they have kept that as an fictitious assets. Now the firm is getting dissolved, so those fake assets, fictitious assets are no more required. So the expenditure they incurred on those particular assets, they need to write it off. And who will bear those things? Those expenses will be borne by the partner, the owners. Okay, so partners capital account and bank account. So these are the three accounts we need to keep it open. Okay, now they need to sell the assets and pay off the liabilities. So when they sell the assets, there are three situations. Okay, first situation, they sell it in cash. Okay, they sell those assets by cash, they get cash amount, and the cash amount will get debited. Okay, so bank account debit to realization account, there are no such assets account. So whatever they deal with assets or liabilities, they will deal it in that particular realization account. So when they are selling off those assets by using cash, so they will get the amount, so bank account debit to realization account. The second situation could be, it can be taken over by the partner. Now remember, partner's capital account is open, right? Now if the asset is being taken over by the partner, now the liability of the firm towards the partner reduces. The firm has a liability towards partner also, okay? But if he is taking over certain assets, so the firm's liability to a partner reduces. What will be the entry? Partner's capital account debit to realization account, okay? Realization account will get credited. And let's say the assets are being taken over by any third party, okay? Not by the partner, but any third party, that is the liabilities, okay? Maybe by the creditors, maybe by the bills payable, maybe by discharging the loan amount they give that particular asset. So in that case there will be no entry. Why no entry? Because both the situation, one realization account will get debit, one realization account will get credited, because there is no such assets and liabilities. Assets are being paid off, so realization account will, assets are being paid off towards a liability, so realization account will debit and the realization account will credit. So there will be no entry when the assets are being taken over by the third person, okay? Now there could be a situation that the assets amount is more as compared to the liability taken over by the third person. If it is more and the person agrees to pay certain amount, then that payment amount we need to record it. If that liability is being paid by paying certain cash amount, so bank account debit to realization account, that is a kind of an income for the firm. Or else if the asset amount is less as compared to the liability and the firm has to pay money, then realization account debit to bank account, the cash goes out from the firm. Now they have to discharge the liabilities, same way they'll pay by cash, okay? The same accounting entry, money goes out, the rules of debit and credit, you just need to remember the rules of debit and credit, okay? So when the money is going out from the business, the bank account is credited. Which account will get debit? Only one account is there, that is realization account. So realization account debit to bank account. Let's say if the partner takes the responsibility of this particular liability, then the firm has a liability towards the partner. If firm is having sufficient balance, firm will pay. Firm is not having, firm will not pay. So if any particular partner takes the responsibility to pay off, to take the money from that particular creditor, so what will be the entry? Realization account debit, because that particular liability is gone, but liability towards partner increases, so realization account debit to partner's capital account. Or the same, if any liability takes over any asset, then again no entry for the same. There is entry for journal entry is not required. There is no need to pass any journal entry, because one account will debit, one account will credit. If there is a difference in assets and liabilities and that person ready to pay off, or ready to he is ready to pay off that particular differential amount, or if the firm has to pay that differential amount, then that particular amount only we will record it in the books, okay? Now there comes the situation of unrecorded assets or unrecorded liabilities. Unrecorded assets and unrecorded liabilities, there was certain let's say thing left in the firm and they forgot to record it, that is an unrecorded assets. Now if there is a certain unrecorded assets or unrecorded liabilities, the situation will be the same, okay? Situation will be the same. If we are paying it by cash, the same accounting entry, realization to bank. If we are paying any liability, unrecorded liability. If it is being taken over by the partners, then if the liability is taken over by the partner, liability towards partner increases, so realization to partner's capital. Or if any unrecorded liability is taken over by any asset, then there is no entry. Similar is the case of unrecorded assets, right? So this is how all the assets will be realized, all the liabilities will be paid off. After that comes what? To do all this work, what comes? The realization expenses, Okay, to do these kind of work, they have to incur certain expenses. So if the expenses are incurred and the expenses are being paid off by the firm, then this is an expense. Debit all expenses and losses, which account? Realization to bank account. Money goes out from the business. But let's see, if any partner pays this realization expense, then the liability of the firm increases towards that particular partner. So realization, any expense is there, realization account will debit. Okay, so to partners capital account. Let's say for this work, for all these settling things, if the partner says, I will take care of this, you need to pay me a remuneration, you need to pay me a certain amount, whatever will be, I will pay off. Then again, whatever remuneration we are paying for that entry will be realization to partners capital account, right? The remuneration paid. Let's say even though after paying off that remuneration, the partner says, okay, I am going to take a responsibility of certain amount, right? I will pay, let's say 5,000 till the expenses amounts to rupees 5,000. But what if the expenses increases by 6,000 or 7,000? Then extra 1,000 or 2,000 the firm needs to pay to the partner. This is an expense. Again, realization account debit to partners capital account. Okay, and if at all, even though the partner takes the responsibility and the firm is paying, then for that it will be realization to bank, the money goes out, then partners capital account debit. Okay, the money goes out, so partners capital account will get debited to bank account. If the firm is paying that particular realization expense amount, so what will be the entry? Partners capital. We are not supposed to pay that much amount to the partner, so the liability of the firm toward the partner reduces because he took over the responsibility and the firm is paying, so money is going out. So partners capital to bank. Now all these effects we have given. Okay, then comes a situation of realization profit or realization loss. After doing all these things, there could be either profit or loss, and whatever is the profit or loss, who is going to bear? The partners are going to bear. So if there is a realization profit, so realization account debit to partners capital account, and if at all there is a loss, partners capital account debit to realization account. Now there is a situation of loan to partner. If the firm has given loan to partner, okay, in that case we are not opening any other account. This loan to partner account will get closed. How? What will be the entry? Bank account debit to loan to partner account. Okay, we will demand money from that particular partner. But let's say the partner has given certain loan. There is a loan from partner. Partner has given a certain loan to the firm. Now the firm needs to pay that loan amount to the partner, but when it will pay? After just charging all these third party liabilities. After paying off all these liabilities, the bank need to check whether we have sufficient balance to pay off to the partner. So they will pay off to the partner, and then whatever is remaining they will pay to the partners. Okay, so you need to understand, after all these things, the balance remain in the bank will be equal to the partners capital account, and that's how the dissolution will happen. I hope you got it. For this, every time I just say that practice and practice. The more you practice, the more concepts will get clear, but first clear your concept and then practice. I hope you got it. See you in the next accounting video. Till then, thank you very much.